This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
Thanks for tuning in. And boy, has it been a crazy 6 months.
Well, I think every time we do one of these podcasts, we both say, could it get any crazier? And it definitely is getting crazier out there.
The ride continues.
Yeah, it's unprecedented.
That is for sure.
To say the least.
That is for sure. But we have a good update for you this quarter. Obviously, a lot to unpack as we made our way through what was basically the second quarter 2025. So as always, Ken's going to start off with his economic update and market update, and then pass it off to me to mainly dive into the equity realms. But without further ado, Ken, obviously just would like to pass it over to you. Keep it open, as always.
As always.
Keep a conversation.
Okay, well, thank you very much for taking the time to watch this podcast. Just want to remind you, as we're closing in on the end of the second quarter, we will be sending you out your quarterly performance reports and also the wealth notes. I will personally be giving each and every one of you a call. It's the summer. It's a little harder to get a hold of you, but I will definitely strive to do just that. And as always, it is extremely helpful if you could take a few moments and watch this video. Very much appreciate that. Thank you. Well, let's dive into this craziness, Cody. I know. I certainly spent some time getting some very interesting charts. And, you know, over the time and when you read articles and you know, from reporters for the Globe and Mail, Bloomberg, or whatever, and from clients' department, they always want you to share the balanced view. You give the pros and then you give the cons, and, you know, it's left up to the reader to decide, well, okay, did that really tell me anything? So I'm a chart junkie, as you know, and the charts I'm about to show you, I went to great lengths to produce these charts, and I think there's a compelling story here, and it's not a great compelling story, but like we always do at Verus, we like to give it to you straight up and how we see it, and certainly charts certainly can tell a picture. So inflation in both Canada and the U.S. has certainly remained in check. On Tuesday, inflation in Canada was announced at 1.7%, but you can see in the United States, when you take a look at all items, we're still, you know, at 2.8. You take out food and energy, and you're down to 2.4. Well, why is that? Well, there's three key reasons why we haven't, you know, seen a resurge in inflation. Number one is because, just like at COVID, consumers, companies were hoarding goods prior to April the 2nd. And the other thing you have to realize is it takes a while. There's a time lag before inflation hits the real economy. And I think third, and probably most importantly, is companies today lack the pricing power to increase the costs of goods and services when the consumers are clearly tightening their belt.
Oh, yeah. A lot of tightening going on.
So I think the world's worst job right now would be to be Jeremy Powell, the head of the Federal Reserve.
I think he's had the worst job ever since COVID.
Yeah. Absolutely. But you know what? The one good thing is he probably has nightmares still about the word transitory.
Yeah, exactly.
But he could resurface to that because inflation may be transitory with the tariffs.
We'll see.
We'll see. But the reality is if inflation does reignite and he has to raise interest rates to curb inflation, that could definitely spark a recession. On the other hand, if he bows to the enormous political pressure, especially from Trump and good old J.D. Vance, that he's got to drop interest rates. If he drops interest rates, it could fuel, and I say the words could fuel, a period where we see stagflation like we did in the early 1970s. So,
well, Trump announced literally yesterday, and that's why the U.S. dollar took a little bit of a hit today, but the replacement of Powell. And I know he's been talking about it for quite some time.
But he can't do that.
Yeah, I know.
Yeah. So,
but he thinks he can do a lot of things.
No, yeah, right? Whatever he says,
yeah,
he says,
exactly.
Right? Oh, yeah.
Yeah.
In Iran, we obliterated all the nuclear plants.
Yeah.
Really? Well, that's yet to be seen. So, what's interesting is the manufacturing sector is a leading indicator, not a lagging indicator, and it does give us some insight into future economic activity. And if you look at the 25 countries there, 18 of them are either at the contraction line or below. That's close to 72% of the 25 countries. And unfortunately, if you look on the far right-hand side, Canada is at the very bottom of the barrel.
We have no manufacturing.
No manufacturing.
Interesting statistic. Ireland, has now outpaced us in terms of manufacturing. They have a population 1/8 of our size.
It's amazing. I mean, Carney has a huge task in front of him. Who knows? But it's, we'll get into that. This is a frightful slide for me, but it definitely sends a clear message. If you take a look at the U.S. and China in terms of their exports and their imports, and you see the current downturn, it's very startling. It's like you can see the downturn in 2008, the great financial crisis. Then we have COVID, and now here's where we are present today. That's, in our minds, just not a soft patch. That is telling us that this is a significant downturn, and it could most definitely lead into slow times, perhaps even a recession. We take a look at the imports and the exports of the U.S. I mean, I think this is startling. In the month of April, imports fell 20% in the month of April. And that was the worst month on record since they started keeping track in 1989. And then you look at new exports. I mean, we're down to 40. That's the worst monthly decline since they've been keeping track again in 1989. But that's a significant contraction. And again, you see those contractions, period, 2008, 2009, COVID, 2020. So that's a telling story. This is another telling story. This one, not a lot of people want to talk about this, but this is the 10-year real yield on U.S. bonds and the revision rates on gross domestic product, GDP. Normally, they move in tandem. They're somewhat correlated. But right now, there's a disconnect. What usually happens is you have high growth, you supports higher yields. Well, it's completely broken down. Exactly like it did in 2006 and in 1999. And again, you can't manage money by looking in the rear view mirror, but that's a compelling story because exactly what happened in 1999 and 2006, we went into a recessionary period. This is the VIX, commonly referred to as the fear index. It's like volatility, volatility, and volatility. And for those of you that are hopefully not looking at your accounts online on a daily basis, you would have seen at the beginning of April, the VIX index went skyrocketed to over 50.
Yeah.
And what's fascinating is in April, between a level of 40 and 20 on the VIX, that is the shortest window that's ever dropped by that much in history. What does it tell you? Complacency, complacency, and more complacency. Tariffs? What tariffs? Wars? Geopolitical risk? What are you talking about?
Yeah.
I mean, you can have Trump on the weekend,
Changes by the minute.
Changes by the minute. You have 125 U.S. aircrafts that travel for 18 hours and drop 30,000-pound bombs for a total of 420,000 bombs, the biggest attack in U.S. history. And what happens the very next trading day? Yeah. Oil drops 5%, and the stock market goes up.
Yeah.
I don't know. I don't think I've learned anything after 40 years.
No, it's
just
the market will humble you.
It's just amazing what's happening out there. And now, you take a look at, good old Trump, the art of the deal, now referred to as art of the fail, because, everybody in the Republican Party and all his supporters and Donald Trump himself is saying, I am the best negotiator to ever be in the White House. I'm not so sure that's true, but there's a lot of people saying he's the biggest bully ever to be in the White House.
Would agree with that. Yeah.
Yeah. How can you not?
Yeah.
So, the reality is he claimed, okay, I'm going to stop the war between Russia and Ukraine. Is Putin listening? Yeah. Putin.
Just lots of claims. Lots of claims.
Lots of claims. It hasn't happened. No. You take China. And you take a look at Xi Jinping. Trump says he's a really tough guy and a tough negotiator. Have they moved the peg on tariffs? Not at all. Did Trump promise that?
Yeah.
Absolutely. And up until last weekend, Israel and Iran certainly weren't listening at all. So I don't think the geopolitical risk is over yet.
No.
Yeah.
Yeah.
And so if you think just because the bombing was so-called spectacular and they annihilated everything in the nuclear bases in Iran, I'm not so sure. It's a little too early to tell. There's all sorts of new acronyms.
There are.
And originally, we had FOMO, the fear of missing out.
There's so many.
And, with the Magnificent Seven, everyone's had a FOMO type of attitude. Yeah. And then there was TINA, which stand for...
There is no alternative.
There is no alternatives. And now we have the taco trade. Trump always chickens out. Well,
you think he likes that one?
Yeah, well, maybe that's why he did what he did on Saturday and Sunday. But the reality is the volatility that we've experienced. So on April the 3rd and the 4th, the S&P 500 dropped by 10.5%. It hit a low of 4,928 on April the 8th. Mm-hmm. And then on April the 9th, the taco trade, what does he do? Suspend tariffs.
Yep.
And the market rallies 9.5% in one day.
We went through that last podcast. Crazy.
Right? Yeah. And now we're at 6,120 and change from the low, 4,900. That's a 23% increase. Yeah. So who knows where this is going, but the sense of optimism is, we talked about that last podcast as well. Well, if you take a look at what retail investors did in the month of April, they put in an astounding $40 billion into U.S. equities, which was an all-time record.
Mm-hmm. Buy the dip.
Buy the dip. Buy the dip. And at some point in time, firmly believe that that is not going to be a rewarding strategy. So Trump didn't realize that Canadians were probably tougher than what he thought, as he wanted to make us part of the United States. But the reality is, in the month of April, flights from the U.S. back to Canada dropped by 30%, and cars crossing the border to and from dropped 35% in April. Unbelievable.
Yeah, and I hear from a lot of clients too that it's just obviously I don't travel. I don't travel a lot, but it's definitely a change in consumer habits with what's transpiring.
And you take a look that Canadians spend $20 billion a year on tourism in the United States, and it's forecasted this year in 2025, the U.S. will miss out on $12.5 billion of Canadian travelers' money. Wow. So if you're a border town, if you're California, you're Arizona, or you're Florida, that's a big problem. Yep. That's going to spur layoffs. You want to get a hotel room in New York? Not a problem. Yeah. You want to go to Vegas? Go to a show? Everything is on sale because Canadians aren't showing up. And that's why the Republicans, and supported by the Democrats in both California and Florida, have put a proposal in front of the Senate that will allow Canadians to stay in the United States if you're over 50 years of age and you own or lease a place. They are proposing to increase your stay in the United States without a visa from 182 days to 240 days because these states are feeling it in the pocketbook. Yeah.
It's a big change.
Yeah, you just take a look at this chart, and that is a huge, the amount of commercial vehicles from Canada and Mexico, especially Canada, has completely fallen off a cliff. Yeah. And what people don't realize is that's also not a good thing for the U.S. consumer.
Definitely.
So there's the taco trade.
And there's the stories. Right?
Well, there's the story, and there's saying how it went viral. Yeah. Okay? Which is interesting, and obviously Trump didn't like the taco trade whatsoever.
No, exactly.
Here's where I was referring to. This downturn here is April 3rd to 4th. That's a 10.5% drop. That's the bottom, April 8th. Okay? Then we go up 9.5% in one day.
Yeah, but that was also... The taco was technically right when he essentially made that truce. When we went through it on Truth Social, when he came out and had that.
Oh, saying it was a buying opportunity in the morning, and then suspended tariffs.
Exactly.
Right? Yeah. Which is amazing. And what I find fascinating is, talk about backing down. So he slaps China with a 145% tariff. China says, not a problem. We'll slap you with 125. Yeah. Where do they settle? Where is it now? 50. Yeah. So is he a bully or the best negotiator? Yeah. So, and again, I have 3 slides left, and this is what I think the real challenge is right now. And I believe firmly that this is the canary in the coal mine. People aren't talking about debt. They're talking about tariffs, geopolitical risks, but very few people are talking about the level of debt. The U.S. has an astounding debt level of $36.1 trillion. And I did say $36.1 trillion. And you can go to Congress and they can, All they want, try to increase the debt ceiling because they have to. They have no other choice. But the U.S. has more debt than any country in the world. And their debt right now is an astounding 124% to GDP, to gross domestic product. 124%.
It's astronomical.
How do you service the interest cost on that?
It's tough.
You can when interest rates are at near zero.
Yeah, exactly.
So I went back because I was curious what the debt to GDP ratio was in the year 2000. So I took a stab, always like to guess. I guessed way wrong. But what, Cody, I'm not trying to put you on the spot here, buddy, but what do you think the debt to GDP ratio in 2000, 25 years ago, what do you think it was?
Well, I know what it was during GFC, but 95.
Yeah, like mine wasn't much better than your 95. Yeah. An astounding 33%.
Okay.
25 years ago. Yeah. We've gone from 33%
Crazy.
25 years ago.
It's a bad guess.
To an astounding 124. Don't feel bad.
Yeah.
I'm sorry for putting you on the spot. My guess wasn't that much better.
No. We've just been in so much, our debt has just rapidly expanded to where it just seems like we've always been in a crazy environment.
Yeah, it's just not U.S. debt. Look at total world, debt.
Insane.
In the first part of this year, total world debt hit $324 trillion, the most on record. And you take a look at Canada, $1.2 trillion. Their debt to GDP ratio is 110. Now, Trump is probably dancing in the streets saying everybody's going to agree to the 5% spending on NATO by 2023. But the Canadian taxpayers are going to flip most of that bill for the $150 billion it will cost Canada a year to get to that target of 5% in defense spending with NATO. Japan has a debt to GDP ratio of 260. 200. Like, this stuff isn't funny.
No, it's not. It's not. But I think I still think, and I'm not going to have time to talk about, obviously, the fixed income landscape, but I will be writing about it extensively in the Wealth Notes.
Yeah.
But a large portion of this, which is kind of concerning now, is basically, I think, for the first time in the last 15 years, investors actually care about fiscal spending and the amount of debt on balance sheets. And it's reflected in long-term yields.
Absolutely. Couldn't agree with you.
So we'll be writing a lot more about that. We have so much to go through today, but obviously that's a big area of what we're looking into for the fixed income allocation of our portfolios. But it's a change, a very big change and inflection point to where print money, it's all fine and dandy, right? Fixed income.
There's no consequences at the end of the day.
But
it
now
will be fine.
The first key point is investors are starting to care. And it
shows. Investors are going to care.
It shows in yield curves.
Yeah, and I think investors are going to start to care about corporate debt. Corporate worldwide debt hit a record $35 trillion at the end of 2024. Mm-hmm. $35 trillion. And when you take a look at banks, you always think of banks as stability and everything's safe. I find this fascinating that the total assets for JP Morgan are over $4 trillion, but they also have close to 92% total liability. Yeah. You take a look at Bank of America. Their total liabilities to total assets are 94%. You take a look at Citigroup. Assets to debit. Their debits are 95% of total assets. So at the end of the day, who really owns the shareholders or the creditors? Well, the creditors absolutely own this. And I think this is...
And that's why they're demanding higher yields.
Yeah, and that can be a significant problem. Yeah. I threw Meta out there and Walmart just as an example to say, no, not all companies are like this. Meta, roughly 34% debt to total assets. Walmart, close to 40%. But the reality is when you hear the word debt, just don't think the governments. Think about corporations worldwide, and also don't forget about the consumer.
Yeah, exactly.
That is accountable for 70% of GDP.
It's a three-way street.
And I just truly believe that this is the canary in the coal mine.
Okay, so thanks for that, Ken. Awesome.
Yeah, you're welcome.
My portion of the presentation, I want to spend a majority of my time really going through the equity side of the equation here. Okay, so that's where I want to spend a lot of the time breaking down U.S., international, Canadian equity markets. As you can see from the market returns, this is updated as of yesterday. It's a mixed bag, but I really want to spend some time going under the hood, per se, to understand really what's going on and what might lie ahead. So as you can see, just equity market returns, Canada off to a hot start. International markets definitely off to a hot start there. U.S. is a mixed bag with the S&P 500 just slightly positive for the year. So we're going to dive into it because I like I said, I want to spend some time there. I've already said that we're going to leave the fixed income just for the sake of time of this podcast.
Yeah.
We're going to have a deep dive on the fixed income space in our wealth notes, so please pay attention to that. But Canadian bond universe slightly up for the year.
Yeah, and it's a good opportunity when you get the wealth notes. If you have any questions on the bond market, when I give you your review call, you'll have ample time to ask me any questions.
So, no doubt, it's been a bumpy ride for 2025. From trade wars to actual wars, it really seems like we've witnessed like a couple years worth of headlines already, and it's only been 6 months.
Yeah, I think Trump wants to go for it.
Honestly,
like he'd do
crazy.
Everything in the first 2 years and then golf for the last 2 years. So.
Exactly. So we've put up essentially the MSCI All Cap World Index. So this is the index that represents the entirety of the global stock market. A large portion of it, as I'm going to show you later on, is the U.S. stock market, but it gives us the good representation. So in the last 6 months, we've witnessed decent start, a sharp correction immediately, which we've gone through. 10% or greater is defined as a contraction.
In one day.
In one day, basically. In some specific cases, we've also seen some indices fall into bear market territory, which is a 20% correction. Then all to be recouped and sharply recover afterwards. So since that 16% correction on the MSCI World Index, after Taco, you already mentioned the figure on the World Index, 23% rally. The ride has been wild, but focusing on the rally itself, it's always important in my mind to dissect exactly what was going on, right? And so what's very interesting to note here is that when we look at the source of that recovery in second quarter rally that began with Trump backing out, it was not an earnings-based rally, but it was an expansion of multiples.
Multiple expansion.
Okay? So roughly 2/3 of the return on the world index for the second quarter was driven by multiple expansion instead of earnings growth. And for those of you at home, in layman's terms, okay, you're at home, that essentially means the rally was not because companies were making more money. It was because investors were optimistic and they were willing to pay more for the same level of earnings. That's multiple expansion.
Yeah.
Okay. So it's funny to note, especially if you look at the US, Canada, and Asia Pacific outside of Japan. You take a look, almost the entirety of US, Canada, and Asia Pacific ex Japan. All the return is just
that's the
valuations
$40
rising.
billion record of going into U.S. equities in the month of April.
Exactly. But what's very interesting to note as you dissect the markets themselves, there's other stories there too. So specifically, you look at Europe and emerging markets. Completely different story.
Yeah.
All of the return was based upon rising earnings.
Yeah.
Right. So it tells us a little bit of an interesting tale. And what's for us concerning about multiple expansion, investors willing to pay more for the same level of earnings compared to an actual earnings-based rally, is multiple expansions are a lot more fragile in nature.
Yeah, for sure.
And over the long run, us at Veris, and I would say even a lot of sound investment professionals, have a conviction that stock prices follow earnings growth. And you need to pay attention to earnings growth. So if we look at corporate earnings expectations, they still remain positive. Okay. The MSCI All World Cap Index is expected to grow 10% for the next 12 months. Not shabby growth, but the key thing being, as shown by this chart here, the guidance continues to be revised to the downside.
Very different than the start of the year when we talked about their expectation.
And the pace of this downgrade is the steepest we've seen since 2023, right? But is it any wonder things are getting downgraded?
Is it
uncertainty
reflected in stock prices?
Exactly.
Absolutely not.
And obviously we can see the downgrades happen because of the level of uncertainty. We don't need to sound like a beaten record about what's going on, right? And especially with the on and off flip-flop stance with Washington and Trump, it's likely going to fuel more earnings volatility heading into the back half of this year. Because companies don't know the landscape that they're operating in. They're constantly adjusting inventories, and it's very tough to run a business when the environment is changing minute by minute by minute.
And you know what's reflective in that is share buybacks have fallen off a cliff.
Exactly.
Because corporations really know that they don't know what lies ahead, and they got to keep some powder dry here.
Exactly. And speaking about keeping powder dry and kind of reeling in the reins, it's starting to show up if we move to U.S. equities. This heightened uncertainty is really causing firms to be reluctant on hiring full-time employees, right? Talking about not knowing the landscape and kind of keeping a war chest at your disposal. That's why they're moving, and we can see on the monthly change full-time employment falling off a cliff, and they're favoring, obviously, more flexible arrangements, which are kind of temporary part-time work, contractual-based. Makes sense as a business owner in an environment like that.
What you got to do.
Right? But it's extremely important to understand, too, and I just keep saying extremely important because it is if we see a further decline in this figure in full-time employment, there's no doubt that that is going to weigh on consumer spending.
Has to.
And as we all well know, if it weighs on consumer spending, it weighs on the broader economy because 70% of U.S. GDP is derived by consumer spending. So it's a tough environment for U.S. corporations out there, right? But it has been, I would say, a good ride for them, especially over the last 15 years, which I want to touch on here. But whenever we're thinking about what lies ahead, I always like to look at where valuations stand, right? And I want to spend a couple moments on this slide to kind of give you an historical perspective.
Does anybody talk about valuations
anymore? Valuations, who cares? What? Just buy it, it goes up. It's all it is, right? But we've talked about Washington. They obviously have a clear intent on reshoring, manufacturing in the United States, implementing tariffs, mainly just turning to a very protectionist stance, right? And as some people say, it's the America first mentality. But in our opinion, we may be heading into an America alone. And it's starting, this entire chaos that's happening in Washington is really causing people to start asking questions. Mm-hmm. And one of those is definitely that foreign capital is considering where it should put its money. And so if foreign capital is now making that question with all the changes that is going on, the key question becomes, well, if there is an exit of foreign capital, it's been mainly propping up the stock market and valuations for quite some time. What's the fair price to earnings value on the S&P 500?
Probably not where it is
tough.
today.
It's tough. But just to give you historical relevance here, this is the Shiller price to index ratio. Okay, Ken's talked about it a lot over the course of luncheons. But for those of you that are not aware, it's essentially the average inflation-adjusted returns over the previous 10 years. So it's known as, essentially, it's cyclically adjusted and gives us, I think, more of an accurate representation of the true price-to-earnings ratio at a specific point in time. So if we look, basically dating back to 1891 to 1989, the historical Shiller PE ratio traded 15 times earnings. Very consistent. Obviously, you have periods, obviously 1920s, highs, lows, but it was in and around 15 times. That dramatically changed following the fall of essentially the Berlin Wall in 1989. Okay? Because the U.S., as most people well know, if you know history, the U.S. became the world's dominant military power. They embraced globalization, and thus foreign capital flowed into the United States at relentless pace because it was a new world order. And that has helped prop up, and it has consistently been the case to where now the average over that period of time from 1990 to 2025 has been 26 times. And I'm not here saying that the U.S., everybody's talking about U.S. exceptionalism. It's been a story for a very long period of time. I'm not saying get out of the United States by all means. The U.S. has some fantastic, best-in-class companies in the world. There's no doubt about that. It's not even an arguing point. Yeah. But from a broader market perspective and these things adjusting, do those valuations make sense? Justify that. And that's where I think it's so important to not just have broad diversification to the indice itself through passive vehicles, but fundamental security selection, I think, over especially the next decade, is going to have its time in the sun yet again. But getting back to this, flows of capital, aka money finding a home, is extremely important because there is a direct correlation between flows and returns.
Absolutely.
So if we take a look at, and this is just Canadian ETFs. Okay, so this is just Canadian investors piling into either one of two choices: international, MSCI EFA, or US, S&P 500. And what we can see is these figures are in billions as to what has flowed in. Yeah. And because this is just Canada, obviously they're still big figures as I'll go down here, but this is the same story consistently across the world. Over the course from 2016 to essentially May of 2025, there has been a total injection into international securities of $185 billion in the Canadian landscape. The US is at $499 billion. A difference of $314 billion more in U.S. equities. For every dollar that flows into international markets, 2.7 goes into the U.S. Relentless flow of capital. And is it no wonder, and this is why I say where money flows, returns tend to follow, is if you look back at this chart and it shows you the performance of international markets versus the S&P 500 and the difference, I've went back even further and said over the last 15 years, and this is why people continue to pile into, over the last 15 years from 2010 to 2024, U.S. markets have outperformed international markets 12 out of 15 calendar years. Mm-hmm. There's only been 3 instances where international markets have outperformed. But is it any wonder with the relentless flow of capital as to why this is happening?
Yeah.
Crazy. But if we look back, what's funny is, we can look at the 15 years, and then we talked about, obviously, the fall of the Berlin Wall, changing the global dynamic, the New World Order. We're obviously becoming, a lot more globalization there, and the U.S. was the benefactor. But if we take the graph further in terms of that outperformance, U.S. versus international, back beyond 15 years, yeah, sure, the U.S. outperformed basically 80% of the time over the last 15 years, but historically since 1970, it's been actually a lot more even. Very even, in fact. 27 times international markets outperformed 28.
Yeah.
Right? So this is a little bit of a concern, and especially with what's going on globally. The demand for U.S. equities has just been tremendous, right? Yep. To the point where that consistent flow has now boosted essentially the U.S.'s portion of the overall world index. To, that number's a little outdated, 63%.
Yeah, it's off the charts.
63% of the entire global stock market is U.S. derived.
Yeah.
But the funny conundrum is the U.S. only represents 26% of the world's GDP.
That's a very interesting stat.
So I don't want to sound like a beaten record, but with the protectionist stance that's going on in the United States, with people and foreign investors now actually for the first time questioning, where do I place my capital? It may not be the United States. I believe in Ray Dalio, classic hedge fund manager who's well known, basically talked about the New World Order, right? Is it happening? Is there an inflection point right here? Because for the first time, we're seeing a little bit of a lift off to where international equities are recapturing some of their market share in terms of the global index. And if not a betting man per se, but with all that is going on, I believe the catalyst, aka Trump, being the catalyst.
I was just about to say that.
The catalyst for inflection is there. And I think there is a tremendous opportunity internationally speaking. Not saying, again, we're completely avoiding the U.S., but I think this is what investors have been talking about. They've been talking about it for the last 15 years. Yeah. International has to have its light in the sun, I think now is the time where the inflection point is going to be true as we enter a new world order, because everybody is questioning the U.S., not America first.
And rightfully so.
America alone.
And that's why we've seen those big inflows into the international markets.
So, interesting dynamic. I'm going to quickly go through this because I know we're a little short for time and I don't want to keep you guys too long. But just flipping gears and looking at home here, we have our fair challenges, obviously, in Canada as well. We've been talking about them a lot. But despite the sluggish demand, our soft labor market, record high uncertainty surrounding, obviously, tariffs and its impact, the TSX has been resilient, surged to all-time highs in June, right? But while there is still soft growth from an economy standpoint, right? And I still think that's going to happen in the second half of the year. I don't think the outlook is entirely bleak for the Toronto Stock Exchange anymore. Okay? And I'm going to get into it. Because as you guys well know, we try to keep our conversations of politics to down a little bit.
These days, though.
But when things were a mess in 2023, 2024 in Canada, you know that we were quite vocal about, obviously, the Trudeau administration. From the large declines in Canadian productivity, population traps.
He couldn't even get NATO spending to 2%.
Exactly. Remember the unrealistic supply? Supply 700,000 homes per year for a decade?
Oh, yeah. We had a slide on that.
Exactly.
It's impossible.
The list goes on and on and on and on, right? But through all of that, what was essentially the moral of that story was, and we vocalized it, Canada was not supportive of a business activity in Canada, aka investments, and that led to substantial flow of foreign but also domestic capital out of Canada.
Yeah.
Right? And it's always good to have the actual podcast because I just want to show you exactly what we said on April 10th, 2024. It all comes down to this. It all comes down to this. We have a government that's not supportive of business activity. Just like his father, Justin Trudeau, is not supporting businesses. Right? Yeah. And so what we're seeing is everybody is essentially fleeing Canada. Investment is fleeing Canada at an alarming rate, and that's leading to a major divergence in terms of our GDP with the United States, as we've seen. So
that was well done.
Just to give you a backlog, it's great when we film things, we could bring them up and show you exactly what we said, but not to beat a dead horse at all, but we've been quite vocal about that. My next point, huge asterisk on this, but I believe that the TSX really stands to structurally benefit from the leadership change in Canada, as shown by essentially Ottawa's last throne speech. Okay? And I know, again, the huge asterisk being these are only words from a politician. So how much can you really trust them? You can say one thing, do another. But on the slide here, we essentially have Trudeau's 2021 throne speech, essentially the policy orientation, and then Carney's throne speech in 2025. Okay? If you go through and you look at each of the individual points, the reason why I think the TSX and the Canadian market can structurally benefit from it. Also, we probably couldn't have got any worse. That's the point,
rock bottom.
Right? We are at rock bottom. Is we're making a large transformation and pivot towards reindustrialization. The government now seems to be committed to obviously leveraging our resource sector, streamlining regulation, which was crazy, and obviously breaking that Trudeau era policy framework, right? Which are all good things. That being said, they are promises. And that's why I have huge asterisks. But I think now, if these do come into fruition and they've been vocalized to the world, we now have a new term in this country. It's called MCIA. Make Canada investable again.
Oh. You little trumper, you.
Definitely not. You wouldn't catch me wearing a MAGA hat at all.
Sure?
But you put that on a hat. Maybe I'll wear.
Change your colors.
Maybe I'll wear
a blue shirt.
Maybe I'll wear
a red tie.
No, but it speaks. It speaks to. And I'm all for it. It's supporting.
That's a new acronym, by the way.
It's all about supporting our businesses, supporting our economy, and making sure that we have economic sovereignty. And I think, hopefully, these are just policies again, but if they are implemented, I feel like will be a very good change for Canada. It all came down to leadership, whether it was Carney, whether it was Poilievre. At some points in time, these were known concerns, but at least I think, hopefully, we will take proactive steps to getting these implemented. And what that does is if we have that make Canada investable again, and we look at still the valuation gap we have between Canada and the United States, we're still at a substantial discount.
Yeah.
Right? And if we can attract both foreign and domestic capital, I'm of the opinion that that valuation gap will shrink. We have an amazing country at our disposal that we can utilize to its full extent. Amazing people. It's just getting us to a place that we need to be.
It's a total shift in the mentality.
It is.
And I think business owners, consumers, everybody's going to slowly start to realize that. And that spells opportunity.
It does. It definitely does. And so that's why I think the Canadian portfolio, or Canadian portfolio, high income up 7% year to date, in line with the Toronto Stock Exchange, amazing dividend yield on that portfolio, is a place that still is always going to be consistent in our portfolios, but is, I think, a place hypothetically of opportunity as we see this valuation gap close. But the key thing becomes is, how does the gap close?
Yeah.
Right? Is it U.S. falling off a cliff while Canada staying stagnant? Is it U.S. staying stagnant, Canada going up? Is it the U.S. falling way more than Canada? The road to essentially how that gap closes is anybody's best guess. Yeah. But we're hopeful that it does close. So just quick note here, I have a couple just kind of, I would say, informational slides. One key challenge also for, I would say, Canadian investors that hold U.S. stocks has been the decline of the U.S. dollar. Obviously, it goes hand in hand with what's going on, both from the tariffs and all the chaos we've spoken about, but also speaks to essentially also the debt levels that are accumulated, uncontrolled fiscal spending. And we've seen, obviously, a large dip year to date in the U.S. dollar, down 4.5%. I think maybe a little bit overdone at this point, but still obviously suppresses a lot of the return when you hold U.S. dollars, even though your mandate may be up 4%.
Well, they enjoyed the benefit for so many years. Right?
But that being said, just something to be aware of.
And that can reverse itself.
It can reverse itself. And you know what? You think about currency too. As much as it is a risk, you can also think about it as a diversifier as well, which is important to understand. And you know what? We've held U.S. dollars for quite some time. As much as there may be a new world order that we've talked about, I still don't think the U.S. dollar is essentially going anywhere. Okay. Last piece of the puzzle, just showing you, these are just informational slides that we'll put up. U.S. equity leading contributors, leading detractors for the quarter thus far. Okay. Mainly talking about the leading detractors. Been a tough run for Apple, even tougher run for United Health. Obviously, it's been just a whirlwind for United Health.
Yeah, well, the CEO gets shot, and then they're getting sued right, left, and center. Yeah.
So it's a mixed bag, though. You can see, obviously, across the board, you have technology companies and leading contributors. Microsoft leading the way, Meta, and Nvidia, Netflix. But then on the other side of the equation, Apple, Tesla, Amazon. Some of them being the main leading detractors. So it's been a mixed bag in the United States, but I think that's why it really comes down to, again, not to sound like a beaten record, that fundamental security selection is always key. It's going to
become important, and buying the broad market and being a passive investor, we've been talking about it for a long time. At some point, we've got to be right.
I would hope so.
Yeah.
Here's a little information on the Toronto Stock Exchange. Basically, really easy story. What led the way in the first half for the year was materials went on an absolute tear, up 32%. And you can see that's why basically all of the precious metal and gold stocks were the main contributors for the Toronto Stock Exchange. TD had a very good quarter as well. A lot of their concerns about lawsuits.
It had a dismal 5 years. Yeah. But what was interesting, there was a survey that was announced this morning. I was listening to it on the way to work, and they're talking about the Canadian banks. And obviously RBC was voted number one, and dead last was TD. Not reflected in their stock price
exactly.
so far this year.
So far
it's
this
the
year.
contrarian view,
Yeah,
right?
exactly. And TD was beat up for a long time.
Yeah.
Right? And and it has been a holding.
That's what happens when you launder money.
Yeah. Exactly. So that's just representation of the Canadian market. Again, QPRs are coming out. Complete details on all the mandates, all of the indices, all of it is going to be available for you. And like Ken said, he's going to be giving you a call as well. So last thing that I just wanted to go through just quickly, we call our podcast Beyond the Noise. I think it's important with all the craziness to really kind of shed light of what's important. And as much as we've talked about, obviously, a plethora of different things, it always comes down to the aspect that returns over time, it's always a matter of perspective. You take a look at the S&P 500 returns and the Toronto Stock Exchange returns, the period from daily, monthly, quarterly, 1 year, 3 year, 5 year, all the way down to 20 years. You can see within those periods of time what has been the historical outcome, whether it's positive or negative. And that's why it always comes back to time in the market is important. Because as you see from a daily perspective, slightly skewed to the positive side, you can have either 54% gain, 46% loss. Chances are slightly skewed to the positive side. But as you continue to move forward, time is your biggest asset. And you can see that positive skew over a 20-year period, everything is positive. That being said, some of our older clients are like, well, I don't have 20 years to wait. That's why we rely on asset allocation, and we're not completely exposed to equity markets, right? And that's where we have our diligent asset allocation in place because we don't have the time in some of your circumstances to recover anymore. And that's why it's so important that you build, obviously, a customized allocation specifically for the stage of life you are going through and your unique circumstance.
Yeah, and you've done a great job of doing that for each and every one of our clients. It is that asset allocation, strategic asset allocation. And as you say, it is about time in the market, not timing the market.
That's correct.
Even though we think we're smart,
but we're here,
smarter than
but
us.
We're always here to make those tactical deviations, right? It's us implementing our conviction on where we see value, what do we see as risky, and that's what we're paid to do, right? And so we make those disciplined strategic calls. So the last point I want to leave you with Beyond the Noise, and I've said this I've presented it at our luncheons before, but to really be a successful investor, it's about focusing on the things you can control. Right? And that's why I say when it comes to investing, why worry about factors beyond our control? Focus on the factors you can control. And it really speaks to what's going on because the factors beyond our control, exactly, politics, economies, market returns, and inflation, tax brackets, all those things, they can cause worry in your mind, but you can't do anything about what's going on with Donald Trump, tariffs, and wars.
No.
So why spend your time worrying that when you should really focus on the things you can control, which is number one, your emotions and your perspective, your security selection, the amount of risk you're taking, your tax efficiency, and optimizing your process. Those are what gets you through the chaotic times. It's what gets you through the noise. And that's why we're here as your partners to make sure that we are really focusing, and you are focusing on the things we can't control and not the things we cannot. Last administrative items. Last piece of the puzzle, like I said, wealth notes coming out. Okay, full deep dive into all the asset classes. We spent a lot of time on equities. Fixed income alternatives are going to be there along with other economic points. And then also our Q2 2025 quarterly performance reports will be coming out.
Yeah.
Okay.
So, thank you very much for listening. I know that was a long one, but there's a lot of craziness going on out there. Also, we are working right now to format our luncheon down at Marine Drive in October. It'll probably be the first week in October. We're looking at dates right now. So, when we send you out the QPRs and everything, we'll be we'll have the date all firmed up by then, but we'd love to see you all there, and I look forward to talking to you in the coming weeks if you're home.
Awesome. Thank you guys so much.
Yeah, thank you very much for listening.